The value proposition of most fintechs share a common thread. They usually strive to disrupt a portion of the traditional way finance is conducted. One of the latest targets is the personal credit card industry. The culprit?
Buy now, pay later services.
Buy now, pay later.
One can say buy now, pay later, or BNPL services have been one of the winners of the post-COVID economic era, since they have exploded in popularity and are now more common than a finance bro with a Patagonia vest. In 2019, BNPL services in the US lended a total of $2 billion. After just 2 years, BNPL providers in the US grew 1,100% and lended a total of $24 billion to American consumers. This polarizing service is seen as revolutionary and equitable by some, and as irresponsible and like a wolf dressed in sheep's clothing by others. The current shifting economic and political tides, however, will test the strength of these companies and their services as they deal with current challenges such as regulation, inflation, and new competition from corporate behemoths. In this video, we will elucidate why are BNPL services so polarizing and game-changing, where they stand today, as well as how the future of this industry might look like. Buy now, pay later services are the digitalization and modernization of an ancient financial model called accounts receivable factoring. BNPL is generally structured like an installment plan for money lending process that involves consumers, financiers, and merchants. Financiers pay merchants on behalf of the consumers when goods or services are purchased by the latter. These payments are later repaid by the consumers over time in equal installments. The number of installments and repayment period varies depending on the BNPL financial model. The service is usually offered for free to the consumer, assuming repayment is made. BNPL financiers take a cut from the purchase price of anything they help the merchant sell. This fee tends to be higher than the typical credit or debit card transaction, with processing fees ranging from 2 to 8% per transaction, compared to 1.3 to 3.5% for credit cards. For example, if Kim Kardashian wants to purchase a $4,000 dress, she can either pay the entire $4K upfront or up to pay 4 payments of $1,000 each spread out throughout 6 weeks. In this scenario, the BNPL company would finance this purchase and pay the store around $3,700 upfront and profit the remaining $300. Theoretically, this system is a win-win-win for everybody, since the consumer was able to get finance without paying a lot of interest. The merchant was able to access a consumer he might not have been able to access beforehand, and the BNPL company took a cut of this transaction. Similar to traditional financial corporations, BNPL companies usually do not use their own cash to finance these payments. A BNPL company borrows money from an allied bank at a premium discount interest rate and then lends it to its consumers at a higher interest rate, especially if they do not pay on time, and then pockets the difference. The fact that the interest rates were artificially low during the pandemic era partially explains the exponential growth in this sector. As the US Federal Reserve increases their interest rates, the BNPL's profit margins will inevitably suffer. The latest financial data from these companies elucidate this reality. The already slim unit margins for the average BNPL service decreased from 1.27% in 2020 to 1.01% in 2021. Additional benefits of BNPL services for merchants include accessibility to a wider range of consumers, a decreased cart abandonment with evidence that they even increase total purchase value and increase impulse purchases. Affirm, one of the leading players in the industry, claims an 85% increase in consumers' average order value after the adoption of their service. Benefits of BNPL services for the consumers include access to credit lending services by population usually negatively skewed with the traditional credit score, i.e. young, female, African Americans, and Latino communities. Also, the ability to make small down payments instead of a large lump sum lets consumers stick to a budget without paying crazy amounts of interest. The American market has shifted the types of goods and services they finance with BNPL services. Apparel and beauty merchants accounted for 80.1% of originations in 2019. In 2021, they only accounted for 58.6% of the loans. On the other hand, BNPL usage for everyday or necessity purchases, i.e. gas, groceries, and utilities, quadrupled from 2020 to 2021, which itself grew 1,1200% from 2019 to 2020. Critics of the BNPL sector argue that there is currently little regulation and that these companies usually target a younger demographic of 18 to 25-year-olds who might be more susceptible to debt and usually lack proper financial literacy. For example, 73% of applicants were approved for BNPL credit in 2021, up from 69% in 2020. BNPL has also been criticized for instilling a false sense of financial security in consumers, which could lead to impulse shopping and spending more on things that they do not need with money they really do not have. One of the biggest cost considerations in the BNPL space currently is default and late payment risk. BNPL providers require far less credit checking in most circumstances than traditional loans and credit cards. With a potential recession on the horizon, there is a substantial risk that a number of consumers might default or find themselves unable to cover the BNPL debt on time. This tendency is already on the rise. 10.5% of borrowers were charged at least one late fee in 2021, up from 7.8% of users in 2020. Currently, the biggest BNPL players include Affirm, a publicly traded US company founded by one of the PayPal founders. It currently has 14 million active users in the United States. Afterpay, an Australian company with 20 million active American users. And Klarna, an OG Swedish company with 35 million active US users. PayPal has recently joined the chat with its own version of BNPL. Due to their overall size of 209 million active users globally, their ability to shift the sector's status quo is evident. With a mean girl, drama-sparking style, Apple has joined the sector as well, with its characteristic style of copying formulas that have worked for others and capitalizing on its devoted and gigantic 45.4 million active Apple Pay users in the United States. Even though most see Apple as the biggest rival for small BNPL startups in the United States, the data suggests that PayPal might be the greatest threat, given that 82% of Americans have PayPal accounts, which is significantly higher than the 27% of Americans that currently have Apple Pay accounts. BNPL stands at a turning point today. After substantial growth in the early 2020s, developed markets are rapidly approaching saturation point. Backlash is brewing in some quarters over the dangers of easy credit access without accompanying financial literacy. It is currently raining cats and dogs for BNPL providers. Recent market volatility and increased interest rates have decimated valuations and made cheap investor funding scarce. The prospect of an economic recession, combined with increased competition and escalating regulatory queries, have tapered these companies' growth and significantly increased the pressure to ensure profitability. In a sector that is no longer immature and close to its saturation point, consolidation of players through mergers and acquisitions is the logical next step. The acquisition of Afterpay by Block, previously Square, and the purchase of Payday by PayPal are high-profile examples from the last years. It is a matter of time until we start to see further regulation in this sector. There are risks, however, in under or over-regulating this industry. Overregulation of this sector will basically crush its value proposition, since it would force fintechs to incorporate traditional risk assessment metrics such as the faulty credit score. Under-regulation, in turn, may cause companies to act shady, target financially vulnerable populations, and fail to disclose certain terms and conditions to consumers, which can increase the chance of default. Regardless of our feelings towards them or how BNPL services will be like in the future, they have already revolutionized the traditional credit card industry. Instead of traditional rollover balances, consumers now have an additional choice to finance their spending. Moreover, consumers' expectations for traditional loan rates have changed. For a traditional standard average APR of 25% in a credit card has become increasingly unattractive. While currently not a part of the traditional credit score report model, data from BNPL services have the potential to play an important role in a novel and future credit score calculation, which might finally be modern and inclusive to all.